This is Tatiana Indina and Mission2Mars Academy online podcast. And today we're going to be speaking about angel investment. And our guest today is Robert Winter. Robert Winter is a long-time Silicon Valley investor, both venture capitalist and an angel investor. He has over 10 IPOs, 20 exits, among 40 venture deals. Robert has generated over 6x cash returns and over 100 IRR for his investors. Robert is a high-performance individual with a broad business, startup, and venture capital expertise. And he is a mentor to so many global and Silicon Valley startups. He was an early investor to companies like nVidia and NetApps and many others. And also currently, Robert is a managing director and the founder of the Vinci Capital Group, an investment firm that is primarily focused on venture capital investing and advising in Silicon Valley. Welcome, Robert. Thank you for joining us today. And we are very much looking forward to learning from your experience and your wisdom on how to invest and how to do it right.
Thank you, Tatiana. Look, I'm glad to be here today. Excited.
Thank you. Welcome. So my question would be, because our audience are global entrepreneurs and global investors. So I will be asking you questions from both perspectives, from the perspective of future investor and from the perspective of an entrepreneur who is seeking to raise funds. So we would definitely benefit from having your expertise as a startup mentor, as an investor, and venture capitalist on all those questions. So my first question would be is, why don't we start from just clarifying the definition? What is it, angel investment, as a profession? Who angel investors are, who are those individuals that are throwing money around in Silicon Valley and around the world? Where do they get those funds? And also, what are some of the good, bad, and even ugly parts behind angel investment as a profession?
Okay, so let's just start off with what is angel investing. So it's angel investing's been around a long time. It's not a new phenomenon. It's become a relatively large phenomenon in the last couple of years, mostly because of a lot of capital that's come to the system, and a lot of entrepreneurs themselves, once they've been successful, have gone off and invested in startup companies. But it's a broad category of individuals that invest. It's not all just entrepreneurs. It's people that are high net worth individuals. And in the United States, there's definitions of what an accredited investor is. I won't go through that. But it's grown quite a bit. Angel investing is usually the first money that goes into a company. It could be friends and family. Now, there's become professional angel investment groups, and groups that form together to angel invest. In fact, right now I'm in the process of a group that I put together. We're going to put $600,000 into a company. We'll wire it next week, so we're funding it next week, and will be the early money into the company. And that's typically how it's set up. It's usually riskier money because it comes in early, with that risk, you're looking for good returns, which means you're looking for relatively low valuations. Sometimes the firm comes in the form of a convertible debt note. In the United States, it's not always pure equity. In fact, you really don't want to have an equity round that early until you have professional investors that priced around. So angel investing tends to be a convertible note. Sometimes a safe note. I'm not as big on safe notes, different discussion. But that's a little bit about what angel investing is and how it's grown. And it's become a phenomena not just in Silicon Valley, but across the United States and to some degree across the world as well too. And I think it will continue to be a force of investing. I think it is driven, I'll add one more quick point. I think it's driven by the fact that venture capital has become much more democratized across the world. In other words, 20 years ago, venture capital was a term that most people didn't understand. Most people do now understand what venture capital at least is or heard of it before. Very, very different than 20 years ago. And I think that's helped facilitate the growth of angel investing as well too. Thanks.
Thank you, Robert. And we also want to learn as entrepreneurs, as startups, what are the specific successful strategies that can be applied in order to raise money from Silicon Valley investors? What I think they are looking at right now? I know those criteria always change, and maybe they're not the same as they were a few years ago, and it's not enough to just come with your pitch deck or like a few slides. And so what are the criteria that investors look at when they're picking their deals?
That's a very interesting question. I don't know if it's really fundamentally changed. There's elements that have changed about the process. So as I mentioned, venture capital's become much more democratized. And with that, there's become broader knowledge and deeper knowledge of what it takes to build a successful company. So there's expectations, but a lot of companies that formulate today have a lot more resources available of how to think through the process of building the company than they did 20 years ago. I think what a lot of venture capitalists did 20 years ago is they look at the microprocessor and they look at, as this thing gets faster and cheaper, what new applications are going to come along, multimedia, the internet, and what are the implications of that in terms of investing. I think that phenomena still continues, but in a little different way. I think the question now is this the right time for that technology to be introduced? Is there a market for it today? Real brief example, you look at Airbnb and Uber, those happened during the Great Recession, 08, 09, where people were panicking about their house and keeping their house, so renting it out was a way to generate capital. Or they had their car and they were looking for additional sources of capital because of unemployment, and so hence the Uber. So that phenomenon created the capability of doing that. Who would have thought that people would rent their house out to total strangers? And that's now phenomenon across the world and has been professionalized to some degree. So it bears itself out of macroeconomic issues, like in that case, but also technology being there. In the case of Uber, as an example, without mobile phones like the iPhone we have today, you wouldn't have the ability to easily pull up and look at where the Uber car was and track everything about it and call one up easily. It would have been much more difficult to do it. Now it's easy to do. So the technology was available at the right time in order for these things to come together. Hence, those companies made sense. So when I look at a company, the first thing I look at is this the right time for the technology? Be it technical issues, economic issues, the macro elements going on. Is this the right time? And it's a very difficult thing because you're looking into a crystal ball, and typically we all get it wrong. And so with that in mind, you got to also plan on contingencies if we're off, because usually in the case of venture capital, particularly venture capitalists, you actually invest too early. So the biggest problem is investing too early into a market where the market's not ready yet. Sometimes in the order of 2 or 3 years. That can make a huge difference between success and not success. Too early into search engine technology, those companies are long gone. Google was one of the late players. There were 20 companies out there before Google. Right time, right place. The next thing I look at, which hasn't changed at all, is the team. It's the transparency of the team. It's the integrity of the team. It's the team's pragmatic approach. It's the domain knowledge. Do they really, really understand the problems that they're going? A lot of people will see some problem and tackle it, but they don't have the deep domain expertise. And it doesn't take very long to see where that flushes out and you don't see any real depth in what's there. I'm also looking for teams, not individuals. People invest in teams and they want to see how that team works together and can grow. So those are the two biggest things that I look for, and I don't think that's changed over the years. It's just been probably a little more refined, and I think, as I shared earlier, the resources available to entrepreneurs has helped them be a little slicker. So you have to look past it because it's not about being slick. It's about solving a problem in a very compelling way and at the right time in the right place with the right team.
Thank you. Just to compare this with a global perspective, because we always speak that Silicon Valley is a bubble, but do you think that the global investors apply the same criteria that Silicon Valley investors apply, or those would be different things?
I think it's the exact same. Again, it's democratization. You know, Silicon Valley may have some unique elements, given that it's a birthplace of, and it's broader, and it's built into the DNA of our environment, and there's a lot of elements behind that. But the concept is the same. It's a universal. And so I don't think it changes wherever you are in the world. I think these issues are the same ones you think about.
Thank you. I as a psychologist by my background, I'm really interested to learn more about psychology of investors. What are some motives that drive them? Because we also hear a lot that investors are also humans, right? They want to like those entrepreneurs and want to love those projects. So what is the psychology of an investor that an entrepreneur should be aware about?
Well, that's a really good question. First of all, investors are not risk takers. Venture capitalists are not risk takers. It's probably a little overstatement, but the point being is when you invest, when I angel invest, I'm looking how to mitigate the risk. How do I reduce the risk? So I'm trying to identify, in the due diligence process, identify those things that are risky, and can I either manage to those risks? Are they really important risks? And try to size up those elements. And every deal has a set of risk, and they're unique to the deal. It could be around the market, the technology, the size of the market not being large enough. It could be around the entrepreneurs themselves. It could be around a lot of different things. So fundamentally, psychologically, venture investors, are fairly conservative, and they take a conservative approach. Now, what they also are is they have visionary. A really good investor will have a sense of vision of where things are going to be, as I shared earlier. That's a very, very important element. And an investor also tends to be very pragmatic. They're not looking for high concept deals that don't have any pragmatic element of happening. And individuals that want to work with people. So there's a natural, I love to work with the startups I invest in. So there's a natural inclination to want to be a part of that experience with it. And the last thing is, I'm a lover of science and technology. So I think investors generally, not all investors, some of them are very, very business-like, but I tend to think the most successful investors embrace technology and science. In that way, they understand what's going on and they relate to the entrepreneur better. When I relate to the entrepreneur, I get eyes that light up, and we connect, and that builds the beginning of a relationship because the entrepreneur is really into what they're doing. So I think these are some of the elements, the psychology of investors.
That's really insightful that you shared those things, Robert, because one of the things that we hear most typically is that one trigger that investors have is this FOMO, fear of missing out. And that's what primarily motivates them, that if you do not invest in this Uber today, tomorrow it might be too late. All right, but there is apparently so much more.
And I'll add to that, I do not fear in at all. In fact, I think that is a gambling mentality, and those individuals, they might be successful, but it's pure luck that allows that to happen. So if you take that mode of operation, it can be very dangerous.
And I feel that finding the right match in terms of also passions and styles of work and value systems even between entrepreneur and investor is so much important. And people say that this is a many years journey, and this relationship is more significant sometimes than a marriage, and can be more complicated. It really requires trust, it requires commitment, it requires good partnership. So speaking of that, what would be the right strategy for a startup to navigate, to find his dream investor, the perfect investor, this perfect match? Because we know there are 15,000 investors in Silicon Valley, and probably half of them will be investing in AI today, and the other half will be investing in autonomous driving, for example. Right? So how would an entrepreneur find and make this decision who would be the right investor?
I think you've asked a very important question, because I don't think entrepreneurs spend enough time on this question. It is more than a marriage. If I may be so crude and rude, in a marriage, you can get married and you can get divorced. But when you invest in a company, you're glued together until that investment exits. And if you have an investor in your company that is challenging, and I've been a part of investment groups where one of the other investors is very challenging, and I've had to work with the entrepreneur in dealing with it. It can be very painful for the other investors, for the entrepreneur. It's actually a big risk issue. So one of the things I look at when I do invest from a risk standpoint, we were talking about risk earlier, who are the other investors? Can I look, there's a deal I'm looking at now that someone's leading, and I have to ask myself, do I feel comfortable with who they are? I don't know yet, but that's one of the questions I will dig into. So it's a long-term marriage. So how do you know? it's like a dating relationship in the sense that you have to spend time together. And it needs to be meaningful time. It's not empty time. It's not, let's go play, maybe there's a game of golf, but it's not so much that. It's talking about the business. You explain the business and being very observant and listening carefully that they, one, understand your business, and also they relate to what you're trying to do. If you don't see those elements in there, then you should be much more cautious. And but it is a relationship building exercise. And that's why I tell entrepreneurs, even if you're not ready for the capital now, or if it's an angel round you're closing and you're later on looking at venture investors that you're going to need to start the relationship building in a meaningful way early on, meaning you keep them in touch with what you're doing. As you accomplish milestones and things occur, you connect with them. It might be a casual phone call, it might be an email, and it might be a group of individuals that you continually update what's going on, because that relationship building exercise is important. And it works two ways too. They need to be working with you on that as well too. So those are critical elements for success on both sides. And if it doesn't, if you have investors, as I shared earlier, that are challenging, it can destroy a company.
I totally agree with you, Robert. And also we hear from many investors that they really want to be friends with those entrepreneurs and, I don't know, have dinners with them and spend more time as people, not just business partners. And also we hear this proverb in Silicon Valley that if you want to get advice, ask for money. If you want to get money, ask for advice, which means that exactly what you said, it takes building relationship as a process before you actually get to the funding point. It takes a journey to be on the same page before you start doing business with each other. Much. And doing due diligence on your investors is also advice that we often hear from so many failed startups. This can be like picking a wrong investor can be one of the reasons why a startup can fail. Do you agree?
No question, no question. And I've seen it happen several times. Very successful companies on the way to being successful, investor gets in there and for whatever reason causes problems.
Yeah, so be careful where your money comes from. But
well said.
Robert, speaking of the mistakes that startups do, I know investors do mistakes too, but what are some of the typical mistakes that entrepreneurs do from your experience that prevent them from successfully raising funds? Is this mistakes in pitch deck, mistakes in their interaction, in the follow-ups, in the process when they already start this legal document signing? What can go wrong and how to avoid this?
Well, that's a very involved question. So I'll hit a couple of points. I could probably spend quite a bit of time just on that alone. Because I sit here and I think about deals I've looked at and how people have handled themselves in the process, and even deals I'm looking at right now and how they're handling themselves. And as this occurs, I'm making judgment calls along the way. So one of the things is to build as quickly and as appropriately as possible a relationship where there can be a dialogue that goes back and forth, and it can be open and honest. And I share with my entrepreneurs when I first meet them that I'm a very blunt individual. You may not always I may not always share what you want to hear. I'm not saying I'm always correct, but at least you'll understand where I'm coming from in the process. And that at least allows this dialogue, I think, to start constructively. What I see a lot of entrepreneurs is they're not organized correctly. I've got one situation now, I'm looking at a deal and I'm beginning to question his organizational ability, big turnoff. I don't see a complete, robust team there when they walk in day one. Or I see a situation where the deck should be immaculate and crisp and to the point, and it should be organizationally correct, but it needs to be compelling. And one of the things when you do pitch, and we're on a pitch element here, but when you do present, you need to present in such a way that you anticipate the questions that investors are going to ask right before they ask it and address it. That occurs by giving the presentation many times and understanding where you're going, but it's the domain knowledge and understanding where there may be holes in understanding an investor, and you fill those before they ask the question. And then you look brilliant as an entrepreneur because you look like because the investors go, wow, they answered that right before. So that's one example of building the right sort of rapport in terms of the business itself. But also at the end of the day, it's how well the entrepreneur really understands the problem set they're solving and how large the problem set is, how compelling their solution is, and can they really build a business and a company, not just a product, but a company around this. And that's the things that if you don't present that correctly, investors are turned off very, very quickly. So I can continue some more, but that gives you a little bit of some examples.
Yeah, because this is a starting point. If you do not present yourself, your project correctly, then it's not going to be further conversation.
Correct.
That's the point where most of the projects cut off. Now let's speak about investors. There are many people today in Silicon Valley and beyond who are looking to start investing and start their career as angel investors. What are some of the key basic things to learn for them in order to make those first steps as an angel investor? What are some of the skills? What is the knowledge that they need to have? What are some of the new habits that they need to acquire? So is it hard? How long it will take, and where to get this knowledge?
First of all, let me share that investing in this space is what I call an apprenticeship business. It's like becoming a master clockmaker in the old days, or a master furniture maker. You don't just learn it in a year. It takes years to learn this. And I've met with individuals that are very successful executives in some of the companies in Silicon Valley that have entered the investing side. And after a year or so, they go, gee, I now realize how involved this is to understand investing. The mechanics of it are not hard. So it's not about the mechanics. It's just like making a piece of furniture is not about the mechanics. It's the fine elements, the feel of what's going on. And the point to that is, like a craftsman building a clock or a piece of furniture, it's only repetition, having done it lots of times, because that's how we as humans learn. It's that pattern element that we're trying to embed in AI now. But I've looked at probably 12,000 different deals in my life. And with that, I've learned a lot of different things. I've seen patterns and types of deals that come along that just don't work, and I tend to move on. I've seen a lot of Me Too's, and individuals that are new to angel investing will see something that looks fresh and new, and it's like, I saw it 5 years ago, just a different version of this from 5 years ago. So the key in investing is to understand it takes a long time to really appreciate the art, and it's an art form. We try to apply science elements to it in the way we approach it, but it's still fundamentally an art form. And so you need to appreciate that. You also should appreciate that you're going to lose money, and you should be prepared to lose money. And actually, if you lose money in the first couple of deals, you might be better off long term. And I learned that from a longtime venture guy when I first got in this business years ago, Paul Weiss at Sutter Hill. And Paul said, if you lose money in the first couple of deals, you'll be a better investor, because you learn those mistakes you made. And it's through the mistakes we make, unfortunately, we learn the most. When things go well, we slap ourselves in the back and go, oh, that's great. A lot of time luck plays into that, but you don't learn as much. So this is a very iterative learning process. I recommend investing with people who have more knowledge that can come alongside you in the process and can be a part of that coaching. But take your time in it. Also, you have to build a portfolio. If you only do 1 or 2 or 3 investments, you're not going to have enough breadth. It's like portfolio theory. You need a portfolio of 15, 20, 30 companies over a long period of time that you can draw from, because some will fail, some won't fail. I've been very fortunate, but I still have had failures. Everybody does. It's a part of the process.
Is it hard to be accepted into a community of angel investors if there is some separate social group, I assume, and they interact with each other and know that all investors know each other? So is this a hard process to become a member of this community, let's say even informally? So what it takes to be recognized by other investors as a serious player?
That's a very good question. And one of the things I missed in your last question, which I'll add here, which relates to this, is, to me, to build the most credibility, if I meet someone that wants to angel invest or is into angel investing, is if they have significant operating experience. They've run companies, they've built products, they've taken products to marketplace, they've been through the process, and if they've been in startups. I sometimes meet people that want to be an angel investor and have none of the right background to do it. And so those individuals can be a challenge because they don't relate. And it doesn't take very long to tell. A couple of conversation in 5 or 10 minutes, and it's very easy to know if there's depth on the other side or not. It's very, very quick. So you need to have real experience. This isn't about jumping into something. You need to have 10 years of operating experience, in my mind, of having brought products to market, having started a company, whatever. Those are important elements because that helps you relate to the entrepreneur. And if I'm going to angel invest with somebody else, I gotta, it's a relationship again that I got to feel comfortable this person will be recognized and respected by the entrepreneur. And if not, then it's going to be much more difficult.
Robert, but we remember that first investors in Silicon Valley, if we think of Silicon Valley history, and you as a veteran of Silicon Valley and a local resident, you might know that first investors were not trained. There were no schools for those investors. They were just early employees of Microsoft, of IBM, of Google, or some first companies that they saved some money, and then they just started the kind of like first investments in just maybe intuitively, right? So what it takes today, and today we see that many managers, corporate managers from large companies, again, they had an opportunity to make some money and they want to start investing, but they might not necessarily be former entrepreneurs or serial entrepreneurs. They might not work in like finance business or venture capital funds, but they are interested to put their money to work, and investing in innovative startups is a big incentive for a lot of beginning investors. So what would be the first steps for those guys, corporate people or people from other backgrounds, not entrepreneurs, where to learn?
Well, first of all, to go back in the history of how this business started, and it really goes back to right after World War II, but the business got started in the early 60s. And I'm going to use your example. That's long before Microsoft even existed. So I remember Microsoft much, much, much later. The early venture guys literally would knock on doors looking for entrepreneurs to invest in. Pitch Johnson, I've heard stories from him, or Bill Draper, these are all individuals in their 90s now. And I know a lot of these individuals, and they're colorful to spend time with about how they did deal flow. It's changed radically. It's much more professionalized now. In terms of the person that's in the corporate side as an executive, it is challenging because what happens is you bring a corporate mindset. I just looked at a deal, and one of the investors that was looking at it had been the CEO of a very successful company that he sold for multi-billion dollars. But he had always been on the corporate side. He'd risen up to the corporate ranks. And this was not a startup. It was a company that he rose up into the ranks to become CEO of. So when I very quickly in talking to him, I can tell that he doesn't understand startups or how to relate to startups. It's a different world. It's like somebody who is a surgeon and somebody who's an auto mechanic. It's two fundamentally different skills. So that's very challenging, and you need to be aware of that. The way I would look at building your credentials is listen, look, attend events, try to find a group of individuals you can relate with, take your time. It's a process of learning. Don't jump in day one. Ask a lot of questions. Read a lot. Not that reading is the full answer, but at least it gives you a framework of how to look at stuff. I've written a lot of material myself that I've given people over time. In fact, it's may become a book someday. We'll see. And a lot of it's around the idea of angel investing because it's a misunderstood art by a lot of individuals. Having been a venture capitalist and now angel investing, it's a much more natural process. I understand what the venture guys are going to look for when that round comes up and how they're thinking about it. I know how I think about it, which is slightly different than the way they think about it. So I do have that context. But if you've never been there, like anything in life, it's a much longer process. So you need to be very patient and thoughtful about it, how you approach it.
Something that we haven't specified at the very beginning, the distinction between venture investment and angel investment, right? Many people still do not have a clear understanding of that other than the size of the investment. And I've heard things that venture capitalists are just money guys, and angel investors are guys with passion who really care about technology and the future and impact. And then there would be other opinions, people say no, and angel investors actually care about money much more because they invest their own money, while the other guys, venture guys, they invest somebody else's money. So what is your perspective? What is
Well, I think you were just touching upon it. It's real simple. Angel investors tend to be individuals. They can work in the form of groups. Sometimes there's angel investment funds, small funds, but the people running that tend to operate as it's their money is involved in the investing process too, closer. Venture individuals tend to go out and raise large funds and tend to invest larger sums of money. The biggest distinction is venture capitalists have to invest their money. They've raised a fund, and they are paid to invest that money. That is their profession. Angel investors, it might be part-time. It might be a hobby. I won't say a hobby, but it might not be a full-time process. And if it is a full-time process and it's mostly their money, they're not forced to invest. So when I look at a deal, I can easily walk away from it. Whereas a professional venture guy is going to get pulled into deals that they normally might not quite do, but because the politics and the amount of money they have to manage is forced in a direction. That might be like an Uber. Some of these unicorn situations that have occurred, the venture communities, large venture funds, have been forced to invest into these companies because of the amount of money that they have under management and the visibility that some of these unicorns have that their limited partners know about. And there's a forcing function that happens that's not always natural. So they're fundamentally two different worlds. But venture guys do bring a lot in terms of pricing and professionalism to the game. That's why I mentioned I don't, even though I love to have a price round early on, at the same time, I'm naturally averse to that because it may not be priced correctly relative to the market. And everything to me should be priced to market. But those are the big distinct differences.
Thank you, Robert. Now the question is about mistakes that investors, especially beginner investors, make, and how to be successful. What are the success strategies and what are the mistakes, and how not to do investment and how to do investment right? What would be your top 5, maybe 10 insights?
Well, we talked about some of these already. I mean, one is, first of all, invest in what you know. Don't invest in something you don't know. If you don't know it, there's things I don't invest in because I don't understand them that well. So that's the first thing. Investing in something you don't know is a big mistake. Second, understanding that your money is at risk and you should be prepared for that. The third mistake that's made is not getting to know the team well enough. And when I say get to know the team, the integrity, all the things we talked about earlier, but also their knowledge of trying to solve the problem is really compelling. So these are some of the mistakes. The deal structure elements we talked about are also very valid too. Who the other investors are, how it's going to be set up, the structure of the deal. These are also very important things that mistakes can be made around. So these are a couple examples, but a lot of it refers to things we've discussed in this podcast already.
I also want to take this opportunity to advertise Robert's course, in fact, 2 courses that he teaches. And Robert is being very humble, but he has 2 perfectly structured and plenty of practical, actionable insights courses. One of them is From Start to Exit, a course for startups, where startups would work with their teams on their product and actual launch of their business together with Robert and under his mentorship. And the second course is a course for angel investors where they will be able in just a few days to learn all his insider strategies and experience on how to invest, how to pick deals, and how to become a successful angel investor. So, Robert, do you have something to say to add, like about your?
No, I think you shared well. I think you shared it well. Thank you very much, Tatiana. But I 2 quick things. I love working with entrepreneurs, and so I've spent a lot of time giving presentations and coaching entrepreneurs, and I love. Now that, angel investing, trying to explain, what are some of the best practices in angel investing, how to think about it. So these are 2 areas of interest to me beyond doing it myself.
And you said right that this is an art, and sometimes those insights can be very implicit, and sometimes those are things, in most cases, those are things you will never be able to get from the books because it takes a lifetime to learn, right? Just like Picasso said, it took me not 10 minutes to draw this piece. It took me my whole life to learn how to do it.
Well, and in terms of a Picasso, or even if you look at Da Vinci, the Mona Lisa took a whole life to paint. And in this process, they learned things as they went forward, which made refinement on what they delivered in a day. Same thing in investing that we're talking about. So good analogy. Yes, please.
I think that many of our entrepreneurs would love to hear some of your stories that you're particularly proud of, or some of the most memorable stories from your investment experience, maybe some of the interesting companies you met, or some of the interesting investment stories that you wanted to share to get people excited or inspired about this, or maybe actual, I don't know, scary stories about investments that scare people out.
Well, there's a lot of stories. Let me see if I can do a couple of quick ones.
About Silicon Valley. Silicon Valley stories is something everybody wants to hear, because this is a very special land where innovation originates. And this is like a dreamland for every investor, probably, because all successful startups come here.
So one investment I made, it was a Series B investment. We were a small investor. I think it was about $500,000, was in nVidia. And this is when they were probably worth about $15 million. And I think today they're worth about $90 billion or close to $100 billion. That's probably my biggest return if you'd kept the stock the whole way. Some I kept, but most of it's been sold along the way. So from a return standpoint, I have an individual that calls it the 10,000x return. Depending on where NVIDIA stock is, it gets close to 10,000x. It's 5,000 right now. So that's probably the biggest deal. I've been fortunate to do deals like that. And also Pharmacyclics, which is a pharma company for cancer drugs that was later sold for $22 billion. And also NetApps. People know NetApps as well too. And the irony of NetApps is a lot of my classmates from school went to go work there. But also there's downside stories too. I mean, one of the investments I made was right before 9/11. 3 or 4 months before 9/11, I made a large investment, later stage, into a software company doing well over 11 or 12 million in revenue, and on its way to doing 20 million that year. 9/11 happened, they never recovered. And it was a very painful story. We went through massive layoffs in the company because 9/11 basically stopped the world. For those that don't remember, for 6 months, very little happened anywhere. And it created huge discourse in ways beyond belief. So those are really tough. There's personal stories I can tell. There's one that I know. Would you like me to tell the story?
About Steve Jobs?
Yes.
Yes, please. We always like to hear the story. I'm pretty sure many people would be curious to learn like things behind the curtain of Steve Jobs and Robert Winter's professional life.
Wow. It's more amusing. And it's interesting because I was talking to an individual the other day who was one of the founders of Adobe. Dan Putnam wrote PDF. He's the one that created PDF, and we're good friends. And he knew Steve as well too. And he's telling me his Steve stories, how he took Steve on 101 when he was running a part of Adobe. So when Steve was let go, I was at Harvard Business School, and I was out here for the summer with Sutter Hill Ventures working as an intern. And Jobs is about 2 years older than me. And he had left Apple and pushed out Apple, started Next Computer, which people might remember. And if you remember the story, and you can look this up, he was out, this is the summer of '86. He was out to raise money, $1 million from 6 universities like MIT, Stanford, Carnegie Mellon, with the view that they would invest in his company and use his technology in the campus and then start Next, which was literally about a half a generation ahead in terms of the technology. It was pretty slick technology for its time. In fact, Mac OS right now is basically Next. It's the Next operating system. So every time you use your Mac, you're still using Next. Paul Weiss, who was the managing partner at Sutter Hill, unfortunately passed away, great man. He came in one day and puts the business plan down on the desk and says, Steve Jobs is coming in. I'd like your opinion. He says, I'm the board of trustees at Stanford, and they've asked me what we should do. Should Stanford invest this $1 million? Today's terms, that might be 5 or 10 million. It wasn't a lot of money, but it was a very political thing that was going on. And Paul was asked, because computer literacy was a lot lower then than than it is now. And so even Paul, who'd been a venture guy, didn't feel comfortable assessing the technical implications of this. So I looked at it, and about a week later, he came in and he says, "What do you think?" And I said, "I wouldn't do it." And he said, "Why? And you know who this is?" I said, "Yeah." Because he was very famous. He was already on the cover of Fortune. I said, "Real simple. There's nothing about building applications here." And I said, that's something we take for granted today. His view was Field of Dreams, or Dream of Fields, the movie, build the hardware and they shall come. And that was his view. And he said, fine, he'll be here next week. So he came in, he presented for 20 minutes. And then afterwards, Paul said, well, Robert's going to share with you what we're thinking. So I shared with him what I just shared. And he looked at me and he said, F you, very loud, and got up and left the meeting. And that was my Steve Jobs story. So I never had seen him, before or since then. But I've been fortunate in the Valley to meet a lot of interesting personalities. Bill Gates, when in young days, Noel Bushman, who started, Atari, started video game Pong. So having been around a while, I've seen a lot of different historical characters. And so a lot of that less and less the younger entrepreneurs see, but it's still in the Valley. You have to go look for it. And it's very Silicon Valley, and that's built the mythos of what Silicon Valley is today. And the thing about Silicon Valley, it's unique. I'll share one element. And this kind of, since you were talking about history in Silicon Valley, or what it is it reinvents itself. It's got a large intellectual group. But I remember when disk drives were a very large part of the industry in Silicon Valley, are making semiconductor chips. All the foundries have gone overseas now, but a lot of it was done here for years. Our printers, building printers, was done down the street in Milpitas or in San Jose or in Sunnyvale. So a lot of these technologies that have moved on, are no longer valid, are not as pervasive anymore. We're here, but the Valley reinvents itself into what is where things are going and what's going on. The biggest challenge the Valley has, besides housing costs, is that it gets ahead of itself, because we think that what we see here is what the rest of the world is seeing. And we're usually ahead of the game a couple of years. So
you are very right by saying that it's really interesting what's going on and where everything is heading, and Silicon Valley kind of lives in the future. So I guess many people still believe that an art of being a good investor is actually to being able to spot those technology trends and to foresee the future. So the question is, how would an investor know what are some of the signals that you need to look at to know what is the next big thing that's coming? Because we know there is like a very tiny window of opportunity for technology to go to market, and it can be adopted or might not be adopted. But so what are the strategies that angel investors use to spot the next big technological trend in the Valley?
I'm going to share something that's probably different than most people think. And I'm trying to be clear about this. As I shared earlier, it's about understanding where things are occurring in inflection points, be it technology, be it macro, governmental, economic issues. We gave examples like an Uber and Airbnb. A lot of people get too locked into a technology. It's not about a technology. It's about a market and solving a set of problems. And if you solve a set of problems and it's a little better, the market generally won't adopt it. Even if you solve it a lot better, some markets are very slow to adopt. I've seen that in lots of industries where a solution is 10, and they still don't adopt it, even when the economics are very compelling because it's an old industry. So in the Silicon Valley, I've seen lots of trends, artificial intelligence being a big one right now, Bitcoin. But in the past, there's been other ones of same magnitude of a technology came along, and it's not about a technology. It's about solving a problem. What I look for, which also is important, is it a unique problem that no one's really solved before? I'm investing in a company the one I mentioned that we're going to close on next week, and I'd be happy to do in a follow-up. Very interesting company, and they're solving a problem that's big. It's a $50 billion problem. That's big enough, and it's unique enough that no one solved this problem before, and it's been in front of people's eyes for a long time. And the technology now has come together to allow you to do it in an economic, cost-efficient mechanism of solving this huge problem. And so that's what I love to see. You know, AI for the sake of AI, who cares? AI is going to be in everything. It's going to be embedded in everything. Versions of it. And AI is a very misunderstood type thing. So again, I go back, I look at markets and solve problems you're trying to solve and doing it compelling way. And that's where you should focus. The technology is going to change. It always changes. Technology is not the key element.
I agree. My last question would be, is that what governments all over the world can do today to facilitate, to get more angel investors in their innovative ecosystems? As we know, early stage investors are key to help entrepreneurs build their innovative technologies, and they're so critical for innovative ecosystems of so many countries. So what the governments can do and should do to get more angel investors in
the biggest thing is to stay out of the way. Keep government regs low. Keep the system simple. Make it easy for the formation of startups, and easy for the formation of capital going into startups. Don't create tax issues. Don't create burden. Make it easy. Keep it clean. Reduce the friction. Make an easy process. That's number one. And that's where the U.S. has historically done pretty well. Long term, don't know, but that's one of the things that's been an important element. Second is to, you know, culturally embrace the entrepreneur. Culturally see that as, you know, the cowboy of yesterday, the individual that's romanticized, because those are the people that actually create jobs. If you look in the United States, most job creations by small businesses, and if you look at all the jobs that have been created through venture capital, it's an enormous number, and our country would be nowhere near successful if it hadn't been for. So you want to create an environment where, as you raise children and they come along, entrepreneur is a part of the fundamental fabric, and that's teaching kids in school about what entrepreneurism. It's the lemonade stand on the corner or whatever is equivalent in another country of getting people to understand, our kids to understand how entrepreneurism works and how businesses work. It's to be very business minded, but also to have an environment of integrity and honesty and openness in the process, because whenever there's any level of corruption that can happen, it will disarm the whole system and it will never work. So these are fundamental things that other places can do. It does take, and there's a presentation I give on this. It's much more involved in discussion here, but it does take other elements that are helpful, like strong university environment. So hubs around universities that are deep are very powerful. Having diverse individuals, having people wanting to come into the area that have different cultural backgrounds and biases and are ethically different, because it's the melting of different cultures that can make 1 + 1 = 3 in a startup. So there's a lot of other elements that go to it, but these are just but a few.
I want to thank you, Robert, for taking time being with us today and sharing your unique expertise with our followers. And I want to invite all of you to sign up for Robert Winter's courses from Start to Exit and best practices of angel investment from Silicon Valley on Mission2Mars Academy website. And we are looking forward to seeing you next time.